Time now for an in-depth look at the market news this afternoon, and for that I'm joined on the line by Dr. Kim Sei-wan, professor of economics at Ewha Womans University. Professor Kim, good afternoon. Thank you for coming on today.
Good afternoon, Devin.
Well, let's start with an issue that is coming to a head this week, the sanctions on Russia, which now appears headed for a de facto default on its debts by saying it's only prepared to pay them in rubles. The IMF sees default as a possibility, but not one that would have a major material impact on the system. Tell us, Professor, what, if any, impact you see a Russian default having on Korea?
Basically, Russian economy is a pretty self-dependent one. The financial bankruptcy, however, of Russia is not an impossible scenario now. Actually, yesterday, Russia should have paid $117 million interest to Western banks, which is not easy because of the restriction to the SWIFT access. Recently, global rating companies like S&P, Moody's, and Fitch all downgraded Russian sovereign rating to C, which is the junk bond level. In the case of Russian financial default, overall impact would be smaller than that of U.S. financial crisis in 2008 because Russian economy is less intertwined with global economy. But Korean large firms like Samsung Electronics and Hyundai Motors have built up European business center and production facilities in Russia. So bankruptcies of Russia will give impact on these firms' European businesses.
Well, shifting gears here, if we talk about inflation, in the U.S. it's at the highest in 40 years. In the eurozone, it's at a record high. The Bank of Korea and some others see that reaching a peak sometime mid-year. But in the case of the eurozone, now with the war in Ukraine, some are pushing that farther out, perhaps into next year. What do you see happening with inflation in these regions?
According to Bank of Korea's recent report, major investment banks are expecting that current high inflation in U.S. and eurozone will come to the boil sometime in the first half of this year. It means that from the second half of this year, the global inflation pressure will be lessened. They say that the global production chain disruption, which is one of the major factors of higher inflation, will be improved because the demands for durable goods like automobiles, computers, and TV sets are slowly declining. But the report also says that in the eurozone, the high inflation can be extended by the end of the year due to the geopolitical issue in Ukraine.
Right, and all of that feeding into the equity markets. Professor, stocks on Wall Street had a bounce back on Tuesday, though, with some fears easing when it comes to inflation and oil prices. West Texas Intermediate crude has come down below $100 a barrel, which of course impacts a number of aspects of the economy and potentially central bank policy. What's the story in the global equity markets?
The U.S. stock climbed on Tuesday after a retreat in oil prices eased investors' concerns about inflation and the prospects that Federal Reserve will move more aggressively to lift the interest rates. Oil's decline came as investors waited for Wednesday's decision by the Federal Reserve, which is expected to raise rates for the first time since 2018. The Dow Jones Industrial Average advanced 1.8%, while the Nasdaq added 2.9%. Oil prices dropped back below $100, undoing much of the price surge since Russia invaded Ukraine. Western Texas Intermediate, the U.S. benchmark, dropped over 6% to $96.44 a barrel. In yesterday's market, particularly Chinese indexes dropped over 4%, related to more than doubled COVID cases in China. But today, the Chinese market surged with the Shanghai indexes 3.5% and Hong Kong's Hang Seng indexes 8.3% return.
Well, the Korean market also taking a cue today from Wall Street, it seems. Foreign investors have been net selling Korean equities, but the Kospi up almost 1.5% and the Kosdaq more than 2.3%. Tell us about the domestic market, Professor.
After three straight trading days dropped until yesterday, domestic markets recovered well today. For the last 3 days, Kospi lost 4.2% in aggregate. But today, the benchmark Kospi advanced 1.4%, and Kosdaq also gained 2.4%. This recovery is much fueled by U.S. market rise and oil price drops. Korean economy is one of the most oil-dependent economies in the whole world. So oil price has been giving huge impacts on domestic stock markets. Most of the large cap stocks traded higher today. Samsung Electronics gained 1.3%, and the second largest cap stock, LG Energy Solution, also gained 1.1% today. Institutional investors led today's rise in both of Kospi and Kosdaq with 512 billion won net purchase.
Well, finally, Professor, the number of people employed in Korea is again up by more than 1 million compared to a year earlier. That's in February for a second month in a row. In fact, the increase for February was the biggest since the year 2000. Where are these jobs, Professor, and what do you see as the significance of this increase?
The job market showed impressive improvements, given that the impact from last year's low base effect sharply fell last month. The number of employed people increased by more than 1 million on year for the second straight month in February due to a low base effect and economic recovery. The number of employed people came to 27.4 million last month, up 1.04 million from a year earlier. The tally was lower than on-year increase of 1.14 million in January, the largest in almost 22 years. But the number of employed people grew more than 1 million is an encouraging sign for the Korean economic recovery. Korea's jobless rate fell 1.5% points on year to 3.4% last month, which is the lowest for February since June 1999. Another good sign is that employment in service sector, face-to-face business, which is the hardest hit by the pandemic, improved despite the Omicron wave.
Indeed, a big improvement in the service sector, and happy for the people that are seeing these improvements as the pandemic goes away. Professor, we're going to have to leave it there for today. Thank you, as always, for sharing your insights with us. We appreciate it.
Thank you very much.